Hey, Eric here from 5minuteinvesting.com. And today I want to share some very exciting news with you because I might have found a buying opportunity. So again, this is the very first stock pick that we're going to do. I don't know if this will turn out to be a pick or not yet because I'm going to do this analysis live. So again, we're not giving stock recommendation here, and whatever recommendation here given is only general advice. So you still need to think about your portfolio and what you believe or your financial advisor provide to you that is correct for you based on your risk tolerance, based on your needs, and so on. And obviously, I'm a long-term investor. I look at the long term, and I'm also using option trading. So you got to evaluate and think if these items are for you. So with that being said, I'm very excited to do this analysis today because I think it might be an opportunity, again, to try to double our account. So right now, when I'm doing this analysis, my account is at 50,000, and we'll see if we can bring it up to 100 in the next 2-3 years. Okay, so here is my disclaimer. Again, just general stock advice, not specific stock advice. And our approach will be news, charts, fundamentals, valuation, insider activity, stock options, basically the whole range of analysis I'm going to perform for you here. With that being said, let's get started. So, why am I even looking at this stock? Well, the first question is, what is this stock? This is the world's most hated company, United Airlines. And if you pay attention to news, in 2017, United Airlines dragged a Chinese man off the airplane. And this Chinese man happened to be a doctor. And a lot of people are angry. And there was a lot of bad news, and the brand is deeply damaged. Now, I can search up when the news happened and so on, but it's in this year. So why don't we do that right now? Okay, here, drag man off plane. That's how easy it is to find. So they fired somebody in October, which is pretty recent, but obviously United Airlines had to pay for it because they obviously made a mistake. This was back in April. So we're going to look at the chart right now and look back at April. Boom. The timing also almost matches. You see right here? This is May. So the stock was still going up, and bam, the stocks start to go down, which is perfect because right now this seems to be dying off. People are getting fired. They're reaching some sort of settlement, hopefully. And yeah, you can see the time frame is in April. So then it probably will. The time frame is in April. So it probably went viral in May. And that's when it hit the stock price, which is a great story on what not to do to try to damage your brand. So, like how we always do it, we always start with the chart. So let me move up here. So the ticker symbol is UAL if you are interested in looking at it. And let me delete the ad here. And you'll see that United Airlines historically has an uptrend. Now, if I zoom out a little, boom, there was a change from 2008 onwards, always an uptrend. Fantastic. This is exactly what I'm looking for. Now, if I hide the Bollinger Band here and just ignore the ups and downs for a moment, whoops, you'll notice that price actually hit the 100 EMA before, which is not the most perfect. But then you see that these pin bars are extremely reliable, even though if you bought it and then the price went here and it went back up. So, okay, understandable. Second, Bollinger Band predicting high and low. Again, Contracting Bollinger Band, which means this low is reliable. Expanding Bollinger Band, this means this low is not reliable. Okay, I don't know why I'm getting these interference. So, okay, and historically, other than 2016, there isn't really another time where it hit the 100 or the 200 EMA, which is fantastic. Okay, let's look at the price action right now. It formed a W. Now, there's a reason why I call my method the W method, because when price forms a bottom, it usually forms a W, and you want to buy at the second W. So right now you see a W right here. So it's formed a second W. Now, obviously, I didn't check out United Airlines until recently, or else I would have bought at $57, which was a fantastic price. And you see that the Bollinger Band is contracting. So then that means this low is valid, and the next low, chances are, will be around 57 to 55 if they will make a low, but nobody knows. So from a technical standpoint, I can already see that, okay, I'm buying options maybe somewhere between 55 to 50. It's a pretty safe spot. It's forming a bottom. Now, would it do this? Probably, but then we can still wait and see when we do more analysis. Okay, so right now we're going to do more analysis and we'll see. So let's check the headlines to see if there's anything. Wow, United Continental announced $3 billion stock buyback program. Now, this was 7 hours ago. When someone announced this thing, there's only two reasons why: either the stock is shit and they want to boost up the price, or the stock is great and the management think they can make money from it. Given that it is a low and United Airlines is trying to buy back its own stock, this is a very strong signal that management wants to push the stock price up. And that is very important because obviously their brand got damaged earlier this year. They want to recover it. And now they're buying back their stock at a low point. So, okay. Boom, airline stock improved Q4. We'll see about that because we're going to do our own analysis. Let's see if there's anything important here. Nope. The stock buyback is probably the most important thing. Okay. Nothing really major here, but the stock buyback is definitely a good sign. So, let me finish the analysis first, then we'll talk about it. So, okay, again, United Airlines has a good uptrend. It's a growing company, what I believe to be, instead of a bankrupt company. So let's start with the income statement. So if we look at the annual revenue, boom, 37, 38 billion, 38 billion, 37 billion, 36 billion. So it's not really growing. It's more mature. And that kind of makes sense because obviously the airline industry is pretty mature. Let's look at operating income. At a loss. Profit, huge profit, and not so huge profit. Now, okay, the question is, why is there a huge profit in 2015? So I was thinking, okay, that's probably because of crude oil prices, because airline depends on oil. And recently there was an oil crash, which obviously the airline can get in for cheap and so on. So I just Googled crude oil 5-year forecast, world government, and this will be the main driver of the share price because that's one of the most important input for airline. So okay, let's look at that. Right now you see that in 2014 it went way down. 2016 went down, which kind of correlates with this profitability. Now, that means when you're looking at earnings per share, the $19 per share is obviously inflated because they're taking advantage of the low oil price, which we don't know if they can take advantage of anymore in the future and so on. And right now in 2016, they still have an earnings per share of $6. So let's say we use an average and we use $3 to $6 as earnings per share. Over the next 10 years, it's going to make around $30 to $60, which is at $60 right now. So given that is so close to the earnings per share, this signals to me that it might be undervalued, which is fantastic. Okay. So you got to understand their year end is 2016 December. So let's look at quarterly. Now, when you're looking at quarterly, there's going to be more fluctuation because obviously airline has a lot of seasonality in it. And if we look at the last 4 quarters, because we don't have the December results yet, which we expect should be good. Now, okay, let me interpret the results a little bit before jumping ahead. So here, net income, you'll see that obviously spring is slower because after Christmas, okay, makes sense. Summer, a lot more profitable. Summer, a lot more profitable. And December is medium. Okay, that's fine because Christmas is small, shorter than summer, and a bunch of people will be working in the winter instead of traveling in the winter, which makes a lot of sense, which is fantastic. So let's look at what we can expect the results to be. So we would add up the net income, 96, 818, 637, and 397. So 1948. Now remember this number. Whoops. Okay. When we compare last year's Q3 with this year's Q3, we know that last year made more money. Obviously, the oil price was lower. This year, the oil price not so much. Okay, that makes sense. Sorry, this one. So they make less money, similar revenue. So this year, not so much because obviously the oil price is increasing. Interest expense, relatively stable. Nothing really jumped out at me, which is fine. So, okay, perfect. If I go back, so if I add up the last 4 quarters, and the reason why I did that, lost my number there, whatever, but it's 1948 here. The reason why I add up the last 4 quarters, because we don't have the December results yet. So if we assume that this December will be the same as last December, then we should have a pretty good idea of what the earnings should be, which should be a 98, obviously. Okay, 98. I think my keyboard just got disconnected. Okay, my keyboard just got disconnected, but I'll fix that later. So you'll just know it's 1948 here. Okay, so we're going to go back to annual and compare with last year. So obviously, last year was 2.2 billion, and right now the projected amount is 1948. So we should actually shave another, let's say 100 million off in December. So how did I get that? So in last year's December is around 400 million in net income. Okay, makes sense. Then let's say the oil prices increased compared with last year, which, okay, fine. So then let's shave 200 million off. So it's 1748. And if you look at that, I don't think it's going to be a significant change in the earnings per share. Because right now it's calculated to be 6.35. And if I take 1700 divided by 1948, my keyboard is working again, then I get 5.54. Okay, perfect. 5.54. So right now, if I look at the next 10 years and to do exactly the same thing, and oil price does not recover back to $100 a barrel, but slowly, they would make $55 in the next 10 years. Of course, United Airlines, America's biggest airline, will continue to operate more than 10 years, but that's assuming zero growth and they kind of maintain like a steady state. Okay, so I think right now the price is fairly valued without any brand or whatsoever. If anything, I think it is a bit undervalued. So, fantastic. So let's go back to our balance sheet. So I didn't check this earlier, so let's see what happens. Again, we only need quarterly, but before we dive in, let's take a look at 5 years to see if anything there is weird. Good amounts of cash, short-term investments, great. Obviously, they have a lot of liabilities, and this is not good. They don't have that much equity. Now, obviously, they have a lot more equity than before. Wow, because the profit they make back in 2015 and 16, but then their retained earnings only recently turned positive, and their debt to equity ratio is around 3-to-1, which is higher than what I want. Okay, fine. And their cash is kind of decreasing. Okay, fine. So it's not the most ideal. Their PP&E has been increasing, which I suppose is mainly related to buying airplanes, which is okay. There isn't a significant change in goodwill, which is fine. So you might argue that, okay, should they impair their goodwill because now the brand is damaged? But chances are the United Airlines brand is not on there. This will be coming from acquisitions, so I think that is fine. So okay, let's go down to quarterly. So quarterly, okay, so right now you're looking at this cash 2.3, very stable. Isn't anything that is surprising me. Inventory, everything looks pretty stable here. Again, this is a growing company or a matured company, so I don't expect a lot to change. What I'm really curious is that if they're taking on more debt, and surprisingly, they're taking on a little bit more debt, but not way too much. And their retained earnings is relatively stable. So, okay, I think it's fantastic. Now, obviously, the debt to equity part turned me off a little because it's more lever than what I want. But if you look at interest expense, it's relatively stable. Now, and in terms of net income, there's good coverage. So even if interest expense goes up by like 3 to 4 times, United Airlines will still have enough money to cover it. Obviously, it's not the most ideal. In fact, the interest expense has been going down. That's interesting. Okay, so I know there's enough coverage for the debt. Okay. The Feds today just said that they will be increasing the interest rate 3 times next year. Now, how much would it be increased by? Would there be any more increase? We don't know. But given amounts of net income United Airlines is getting, and given that crude oil prices is not like drastically increasing, which will kill United Airlines, I think we're okay. And I don't expect crude oil prices to be going back up to 100 because obviously there's some new crude oil extraction technology in the US, which makes US one of the biggest exporter for oil. So that definitely helps given that United Airlines is based in US. So having said that, let's look at valuations. Now, given the recent price decrease, United Airlines is undervalued in terms of price to earnings. And we all know that S&P is at an all-time high. We know the industry is at 15, which is reasonable, and price to earnings is at 10, which is great because when we do our analysis, we did it over 10 years, and we estimated it to be around $55 to be the fair value, which is fantastic because it means that United Airlines can go up to 15 once this whole brand issue is resolved. Again, price to book, undervalued because the price is lower than what is on the book value. I don't think the brand is included in the book value, so that is another plus. So price to sale, again, well, undervalued as well. So fantastic. let that be. So that's 3 of the indicators are telling me that United Airlines is undervalued, which is fantastic. Price to cash flow, it's a little bit higher, but I'm not too concerned. And finally, dividend, they don't pay any dividend. Now, this is very important because when I'm buying stock options, I don't want a stock that pays dividend because that will lower the value of the stock. So technically, you can say, oh, well, it's kind of built into the price. So when you buy the stock options, it should be already adjusted for. But it's just another thing to worry about, which I'm not too happy with. Okay, so they're not paying dividends. That is fantastic. Better for stock options. Now, you might notice this company is quite leveraged. But I don't want to pay $55 to buy United Airlines. I'd rather pay $25 or $20, knowing that United Airlines would have a hard time coming down to the 40 to 50 range here. So I know that if my strike price is near this range, I should be pretty safe. So yeah. So the last thing we're going to look at is insider activity, which I'm super excited about because I hope I actually get a positive confirmation from the government, from this indicator. So now, is there any sale? The most recent sale was back in June 15th. Okay, perfect. So June 15 was obviously back right here shortly after the bad news for 230,000. That's not a lot of money. Okay, so recently we have a purchase at 60 bucks. Right now it's 63. So obviously they have an information advantage over us because they're upper management, they know how the company's working and so on. So we're not too far behind. So that's good. And then we have another purchase here. We have a disposition here of, it's not a sale, but it's a disposition. So we don't know if this was because they bought it a long time ago and so on. So this is unclear. And then we also know that Robert, the chairman of the board, just bought at $58. So both people are buying at $58, $59, and we're not too far behind, which is fantastic. Guys. The last thing you want is that you missed a boat. But like Richard Branson said, there's always another opportunity. It's like buses. Sorry, the full quote is, opportunities are like buses. There's always another one coming around. So okay, let's take a look. Back before, so this is back in June, people are disposing their stuff, which is fine. We know it's high. So here, the other recent one is 78 and 69. So obviously we have some wiggle room because 78 to 69 is around upper here. So I'm pretty happy given the amount of wiggle room we have. Yeah, okay. So we're not too far behind. We know that they recently bought, and the price people bought it, or the timing in which people bought it, was September 15th and October 24th. So September 15th. Okay, let me move myself over here. September 15th. Ooh, wow. Wow, this person, whoever bought it September 15th, is a genius here. It's very hard to time it that right. And the other person bought it was October 24th. I'm surprised there are only 2 directors that bought it. Okay, so that one bought after a large drop. Okay, so this formed a W, which is fantastic. Obviously, you think, would there be more people jumping on this trend and this opportunity? So at this point, I would say it is a go. Obviously, I'm observing the price, so I don't think I want to plunge into this yet. So how long does it take for someone to recover from a damage in their brand? And I happen to think of the perfect example. Now, I need to check to see if they do have a stock. And boy, they do. DPS. Now, okay. Perfect. Okay, this is the perfect example. So back a few years back, few years back, there was a huge issue with Domino's, but I'm trying to find a date. Growth. Huh. So back then, there was a really, really bad, here. There was a really, really bad incident where Domino's employees basically tainted the food and gave it to the customer, and it was disgusting, and the video went viral on YouTube. In fact, if I search it now, I bet I'll find it. Domino tainted food. Let's see if I find it. So how to get fired from Domino's. Now that was 8 years ago. That means it was back in 2009. So we can use that as a case study to think, okay, well, back in 2009, what happened? Now it's probably somewhere around here. Okay, I couldn't find the exact date. 2009 April. Now, obviously, it was right after the crash, so it probably did a huge damage to their brand. And that's 2008. That was because of the housing crash in the US market. So if we look at April, it's right around here. And it actually didn't do as much damage as I thought to the stock price, because obviously it's already at an all-time low. It can't go any lower, and then afterwards it's just a straight uptrend from here for Domino's. Wow, I should have bought Domino's, eh? Now it's at $180. So what is the lesson? Is that the market does forget. Now that's important. So okay, I think this stock is ready for stock options. Now, okay, right now, let's look at strike price. Before we even look at the NASDAQ stock option chain, what would I want the strike price to be? And the answer to that lies in what I believe is good, what I believe is safe. So it'll be based on the most recent lows. Obviously, United Airlines had a history of breaking through the 200 EMA, which is a small negative sign, but that's a risk I'm willing to take. So we know right now the price is $63, and our goal right now is to try to buy it as low as possible, closer to 60 probably, but chances are we wouldn't get there. So our strike price can either be 50, which is a psychological benchmark, but there isn't a support and resistance to support it unless you go all the way back to here, right? And the next one is 45, and the next one is 40. So these are pretty hard price points to hit. And if we want to think about how long it takes for the United Airlines brand to recover, probably in 2 years. So I would buy the stock option in 2 years. Whoops. I would buy the stock option for 2 years, which is January 2020. Now, right now we're at 17, so 18, 19. So that should be enough time for the brand to recover, assuming there's no more fucked up from United Airlines. Just swear on this channel here, which I don't want to. So now the question is, we want to calculate the premium, and we want to think which option will give us the most bang for our buck. Now, okay. Wow, getting an ad here. Okay, ignore that. So, right now this price is 63, and our options are 45, 50. If we are really stretching it, we can perhaps buy 55, but I wouldn't go any higher than that. So we would consider these 4. So there wasn't anyone trading here, which is interesting. So, okay, I need to do some math. Let me grab a piece of paper here. Or I can figure out a way to do it on the screen. Okay, let's do that. Okay, let's do the easiest one. Let's do 55. So 55 plus 16, that is $71. So if I buy right now, United Airlines has to go up to $71 for me to break even. Okay. So let me explain what I just did. All right, so my computer has a bit of a technical issue here, but then hopefully it's fixed, and I'm going to finish recording this video no matter what, because that's how important this video is. So let me explain what I just did. So I was looking at the $55 option at $16. So $16 is what you're actually paying for. The strike price is $55, so that leads to $71. Now, right now, the stock price is $63, correct? So then I'm paying a premium of $8, which is 71 minus 63. Now, what does a premium of $8 means? Now, for those of you who haven't taken the option course, it means that you're paying for the fact that you're holding on to this option for 2 years, or you're paying for the fact that the stock itself is volatile. So the more volatile the stock, the more fluctuation it has, then the higher the premium will be. So there's a time component and a volatility component within it. So as time goes on, this $8 will be smaller and smaller and smaller and smaller until it becomes zero. So at the end of 2 years, you'll have, let's say the price is still 63, and your option with a strike price of 55 will be worth exactly $8. Now, you don't want to confuse this with the $8 here. This is derived by 63 minus 55. So you'll understand this more as you go through the options course, but essentially this is how I look at options. So let's say we take another example, the $50 one. Okay, let me fix the bracket here. So if you take the $50 option and you know that it's selling at 22, then you know that the price is 72. So that means at $63, you're paying a premium of $9, which is 72 minus 63. Make sense? And if I go further down, let's say 45 plus 24, that gives you 69. Oh, you see what I did there? Then at this point, 69. Did I do the math right? Huh. At this point, you will notice the premium is decreasing. The premium now, it's only $5, which is a lot less than before. And the cost is not that much higher. Now, I don't know if this is true. Oh, because here, you see the last price is closer to the upper end, which is the ask price, than what they have here. So it really depends on your bid and ask. Obviously, the lower the price, the more you can buy. So for the 55, I wonder why nobody's buying 52.5. Maybe because it's not a round number, which is why it's not like people are not a big fan of it. So we probably want to calculate the mid-range, because when the market is open, you'll probably get the mid-range. So here is 17.75. So if we look at a $55 option at 17.75, then we're going to be around $72. And if we look at a $50 option, and the midpoint is, that means it'll be around $71, which is still pretty accurate using what we have calculated here, the $50 option one. So the $9 premium is still quite high. So if we look at the $45 option though, and we take the midpoint, let's hope my computer isn't gonna crash. Obviously, it might at any given point in time. $45 option, which is 25.7 plus 22.3 divided by 2. So that's 24. That means I actually get $69 is my break-even price. And that's a lot better. So this is the exercise you need to go through before you buy, because $69, look at this. This is much more achievable than before. Okay, let's look at the $40 option. So $40 option, just at a glance using this price, you'll get 69 as well. So it seems like 69 is our bottom price. So right now I'm pretty happy with the option and the volatility. So my strike is going to be between 40 to 45, which is a lot better because that gives me a lot of safety room. So I can delete this one now. And basically, over the next week, I'm going to wait to see if it pulls back even further. Because right now, you see obviously as a high. So right now I'm looking at the daily chart. And I only look at the daily chart so that I can be more accurate than before. And you see that the Bollinger Band is expanding. You see that it did two tops. And you see that right now it's doing a retracement. So we might be able to get in at a lower price, maybe around 61. Around 61 here, closer to 60 next week. If it is, then I'm going to go in. Of course, I'll send you an email when I go in. So I'm doing this analysis before I entering. So then I avoid any guru saying that I'm doing pump and dump or whatever. Because in the stock market, if someone has influential power, I can technically enter it first and then I tell you about it. So then you guys drive up the stock price and I exit afterwards. But obviously I'm a long-term investor and that's not why I'm here. So I'm only here to give you a good stock pick and you can decide whether it is for you or not. So right now my account is around 50K. So I believe I can put 1/3 into this stock. So that would be approximately 15 to 18K. Of course, I wouldn't want to put everything in right away. So then that means I'll have some time. Maybe I'll separate that into 3 chunks. So for me, with an account of 15K, and I know that the final position for this stock is around 15, then I'll probably buy 5 right now, maybe 5 Monday, and maybe I'll wait a week or 2 to see if it goes back down to 60, and I'll buy 5 for the remainder. So that should get me pretty close with a strike price of 45. I think I'm going to go with the 45 option. That one is pretty good because the premium is the least. I'm not really paying that much more. And oh, I forgot. The most important thing we need to calculate here is how much money or what is the price I need to double. And in order to do that, it's super simple. All you got to do is 45 plus 24 plus 24. So the price I need to double for this stock is $93, which is actually higher than before. Wow, it's actually at the highest high. Huh. So that's actually problematic. Because if I buy, so right now it's plus 50, so $95 for me to double my money here. So I need to go all the way up to $95 for me to double my money. But if I buy this one, then it only needs to go up to 85, right? Which is right here, 95 or 85. And I have 2 years. So if I invest this stock, then chances are I'm not going to be able to double my money, but instead I might obtain like 70% or something. Okay, so if I do this, let's say the 65 one, if I do the 61, then it's going to be $90. So either way, my options are here. I buy the 45 strike price, which is more conservative, and it's going to be $95 to double. Or I buy here, which is going to be $90 to double. And you know what I'm doing? So I'm actually timesing the option price by 2 because it has to go that much higher, plus the strike price. So if I buy here, it's going to be like 87-ish to double. Okay, I'm still fine with the 45 one because I want to wait to see if price actually goes lower again, so closer to 60, so that I don't need to put in as much money. So then if it goes to 60, chances are this thing is going to be around 20 bucks. So that means I still need the price to go to 85 to double. So basically it needs to reach a high again. Now, Having said that, though, we do know that we are at a high point in terms of the S&P. There is a risk that a crash is imminent in the next 2 years. So when you are investing, you got to keep that in mind, that if there is suddenly some sort of bubble or bad news that signal the bubble is going to be burst, we want to exit. So with that being said, next week I'm going to find an opportunity to buy United Airlines somewhere closer to 60. If it is below 60, it's fantastic. I'm going to put more money in. But hopefully it's below 60 or close to 60, like 61, 62 or so. So for me, that is buy. I'm 90% sure that 2 years from now it's going to be between the 70 range, 70 something, 80 range. So I think that is really doable in 2 years. And given that management hasn't shorted it since a while, since June, I'm quite sure the stock will go up. And obviously, if you look at this news, management do want the stock to go up, which is why they're buying back the stock. And given that the oil price is low and it's not going to quickly rise in the near future, for the next 2 years, I still think United Airlines is going to be performing quite well. And the longer we wait, the more people forget about what happened with the whole dragging people off the plane thing. So then the brand will be restored, and overall they have an uptrend. There might be an opportunity to buy later on. I don't see that it doing a dip lower than the $55 one, which is right here. I don't see it passing this point. In fact, I don't think United Airlines usually passed 200 EMA other than that one time. So yeah, the revenue part is not super fantastic and they're a bit over levered, but I think they would still be able to pay off their debt given how low their interest is. Even if USA increased their interest rate 3 more times next year, I think United Airlines wouldn't be going bankrupt anytime soon. That's what I think. Yeah, so good luck. Analyze this stock to see if it fits your portfolio, and I'll keep you updated as it changes. Obviously, my time frame is 2 years, the max that is offered on the market today. So I'm not worried about the small fluctuations once I'm in. I'm mainly just in there. I'm going to check the market once a week if I really need to, or else I'm just going to wait at least a year, because you're not going to get an opportunity to sell right away after I enter. It's more like you're checking it to see if there's a buying opportunity to buy more in this range. Like right below 64, I would consider that a high, and 58, which I consider that to be a low. So hopefully we'll get in as low as possible. Keep you posted. Cheers.